This week we're going to cover Chapter 1. Now, Chapter 1 deals with the financial reporting environment. Chapter 1 also presents an overview of the financial reporting environment to explain how capital markets rely on the credibility of published financial statements. Now, there are many factors that impact decisions made by firms, and the financial reporting process extends far beyond the financial statements. So in Chapter 1, it will provide a definition of financial accounting and the supply and demand of accounting information. It will also discuss economic entities that prepare financial information and the users of those information. And also, Chapter 1 will explain the factors that shape financial information. So the learning objectives for Chapter 1 are: define financial accounting and describe the demand for financial information. 2, discuss the role of financial accounting standard setters in the US and internationally. 3, detail the standard setting process. And 4, explain 3 recent trends in standard setting, which are principle-based, rules-based, and objective-oriented standards. And of course, we're going to discuss this farther in Chapter 1. So the first objective we're going to discuss right now is define financial accounting and describe the demand for financial information, including the role of general purpose financial statements, the information needs of financial statement users and other parties, and the factors that influence financial reporting. But before we get into Chapter 1, we first will have to define what is financial accounting. What is financial accounting? Financial accounting is the process of identifying, you're measuring, and you're communicating financial information about an economic entity to various user groups within the legal, economic, political, and social environment. So the definition of financial accounting contains 4 major elements. They are: 1, financial information. Now, financial information is the first element of financial accounting. 2, economic entity, which is the second element of financial reporting. 3, user groups is the third element of financial reporting. And legal, economic, political, and social environment is the fourth. Again, like I stated earlier, the first element of the definition of financial accounting is financial information. Now, financial information falls into 2 categories: information that is or is not governed by rules set forth by the accounting standard setting bodies. Now, firms prepare the financial statements and the footnotes to the financial statements, also referred to as footnote disclosures. It's based on accounting standard setters rules. So in contrast, the letter to the owners, management's discussion and analysis, The auditor's report, the management report, and press releases are not governed by the accounting standard setting bodies. Although they are regulated to some degree by other authoritative bodies, but they are not governed by the accounting standard setting bodies. The form, content, and extent to which firms provide financial information is based on market participant demand. Financial accounting provides information that enables users to evaluate economic entities and make efficient resource allocation decisions based on the risk and returns of a particular investment. Now, this process directs capital flows to their most productive uses. So in this way, the demand for financial information is linked to the allocation of scarce resources, as you will see here in Exhibit 1. So what is capital? Capital is a scarce resource. Accountants report the economic performance and financial position of the firm so that the potential debt and equity investors can adequately assess the risk and returns of investing in the entity. Now, similarly, lenders can use the financial statements to assess the potential for payment. For example, a bank limited in the number of loans that it can make would clearly prefer to lend to a business that has been profitable over the past 5 years rather than one that it has not. So what are the 4 basic financial statements? Now, this is something that you should have learned in your previous classes. The financial reporting process generates a significant amount of financial information that yields the 4 basic financial statements, as well as the footnote disclosures. Now, in this chapter that follows, we examine the theory, we're going to discuss the rationale and the principles underlying the 4 basic financial statements. And what are those 4 basic financial statements? You have your balance sheet. You have your income statement. You have the cash flows. And of course, the 4th is the shareholders' equity, statement of shareholders' equity. Now, published financial statements are called general purpose financial statements. And they're called that because they provide information to a wide spectrum of user groups. For example, investors, creditors, financial analysts, customers, what else? Employees, competitors, suppliers, unions, government agencies. Now, although considered general purpose, most financial information is provided to satisfy users with limited ability or authority to obtain additional information, which includes investors and creditors. So FASB, the Financial Accounting Standards Board, which is the body responsible for promulgating U.S. the GAAP. Now that identifies investors, lenders, and other creditors as the primary users of the financial statements. These financial statements, along with the Accompanying footnote disclosures are the primary resource of publicly available financial information for investors and creditors. Now, none of the other sources of financial information, such as management forecasts, the press releases, and regulatory reports, none of those other sources, none of these sources provide as much information as the financial statement. The term financial information includes more information than the financial statements. So the term financial information includes more information than the financial statements. The financial statements include the 4 basic financial statements and the related footnotes. However, financial information also includes items such as the letter to the shareholders, a formal discussion and analysis of the firm by the management of the firm, management report, auditor's report, and financial information or financial summary. Remember that the definition of financial accounting contains 4 major elements, which are what? The financial information, economic entity, user groups, and the legal, economic, political, and social environment. Now, the second element in the definition of financial accounting involves the economic entity for which the financial statements and other financial information are presented. So an economic entity is an organization or a unit with activities that are separate from those of its owners and other entities. An economic entity is an organization or a unit with activities that are separate from those of its owners and other entities. Financial information always relates to a particular economic entity. Now, economic entities can be what? Corporations, partnerships, sole proprietorships, or governmental organizations. Also, economic entities may be privately held or publicly held. If the entity is publicly held, then its equity can be bought and sold by external parties on stock exchanges. The management of a particular economic entity prepares its financial information, including the financial statements. While the management of the entity may also use the financial information to some extent, they are better classified as preparers than users of financial information. So again, while the management of the entity may also use the financial information to some extent, they are better classified as preparers than users of financial information. The third element in the financial accounting definition involves identifying the primary user groups that demand financial information. Some users employ accounting information to make economic decisions for their own benefit, while other users employ accounting information to make economic decisions for the benefit of others or to assist others in making investment or credit decisions. Here you see it in Exhibit 1-2. You have the equity investors, which are the shareholders of the company. Creditors and other debt investors are entities, including banks and other financial institutions that lend money to the company. Competitors. Competitors use financial information to determine their market position relative to the reporting entity, and companies analyze a competitor's financial information to identify its strategy and determine if it's possible to successfully compete with the company. Here you see financial analysts, employees and labor unions, suppliers and customers, government agencies. All of these are considered user groups. Financial analysts, they're employed at investment banks or commercial banks and brokerage houses. They use financial information to provide guidance to individuals and other entities in making investment and credit decisions. Another important group involved in the financial reporting process is the preparers themselves. Financial statement preparers are the companies that issue the financial statements. So in addition to preparers and users of financial statements, other parties involved in financial reporting process include external auditors, internal auditors. External auditors, of course, are independent. They're independent of the company, and they're responsible for ensuring that management prepares and issue financial statements that comply with accounting standards and fairly present the financial position and economic performance of the company. Internal auditors are employees of the company serving in an advisory role to management, and they provide information regarding the company's operations and proper functioning of its internal controls. The accounting standard setters, they develop accounting concepts, rules, and guidelines that provide information that is relevant and faithfully represents the economic performance and the financial position of the reporting entity. The FASB, the primary standard setter in the US, it promulgates US GAAP, right? The International Accounting Standards Board, which is the IASB, it sets international financial reporting standards, which is the IFRS. Now, the regular bodies, they protect investors and they oversee the accounting standard setting process. Now, here in the US, we have the SEC, which is the Securities and Exchange Commission. They regulate publicly traded companies. And the PCAOB, which is the Public Company Accounting Oversight Board, they set accounting standards and they oversee the audits of public companies in the US. And then we have professional organizations. Professional organizations are involved in financial reporting process. You have the American Institute of CPA, which prepares and grades the uniform CPA exam. Any questions? Thank you for watching. And please, if you haven't already, please click the subscribe button below. And also look out for our next video. Thank you for watching.